Good morning and welcome this morning to Long Verticals and Diagonals, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I'm joined out there in the chat today by my good friend Brent Morris, 20-plus year veteran of the financial markets and a great educator. He's going to be there to help specifically answer the questions that you bring up in the chat. Speaking of that, thank you for joining us in the live version today. If you're joining us in the recorded version, after the fact, you can participate in the discussion as well by leaving comments in the comment section. Thanks for joining us and being here in this discussion. We're going to talk a little bit about long verticals specifically today, and based on what the current market is doing and the fact that volatility is relatively low, which might or might not be a circumstance that benefits us as traders of long vertical spreads. So that being said, a couple of quick housekeeping items that we want to take care of in this discussion today. Remember that everything we talk about simply for illustrative and educational purposes only, shouldn't be considered an individualized recommendation or endorsement of any particular security or pattern or strategy. Remember that options carry a high level of risk. They're not suitable for all investors. And make sure that you're aware of the characteristics and risks of standardized options prior to trading or considering any option strategy. Remember that multiple leg option strategies will involve multiple commissions. Remember that spread trading must be done in a margin account, so be aware of those circumstances. We're going to use technical analysis in this discussion. Remember that technical analysis is only one way to look at the market. There are others. All of them are theoretical in nature. None of them are guarantees. But because of that, Schwab doesn't recommend the use of technical analysis as a sole means of investment research. Now, we're going to be using the thinkorswim desktop software platform, specifically the paperMoney version. It's not a guaranteed future success out there in the real world, but it is a great learning environment. Now, one thing to keep in mind, there are some differences between paperMoney and the live trading account. paperMoney does not facilitate the early assignment of short options. Remember that anytime you're short on options, potentially you could be assigned that obligation. That's going to come into play when we talk about long vertical spreads, because that could potentially benefit the trader of a long vertical spread, that circumstance of being assigned and exercised. So we'll take a look at that as we get into the discussion. Remember that investing involves risk, including the loss of principal. Remember that as we discuss anything, that past performance of any security or strategy doesn't guarantee future results or success. So let's take a look here. We're going to talk about long vertical and diagonal spreads, specifically long verticals today, but we'll talk about some of the reasons why a trader might extend a trade into a long diagonal as opposed to a long vertical. We're going to talk about the impacts, price, time, and volatility. We're going to look at some example trades here. So I'm going to shift our view over to the thinkorswim desktop software platform here. I'm going to change back to the charts tab. We'll take a look at what's going on in the market as a whole. And as I do so, quick reminder, if you haven't done so already, we'd love to have you click on that subscribe button down at the bottom of the page. That's going to make sure that you stay connected to the Trader Talks webcast channel. It's a great subscription because it doesn't cost you anything and it brings you lots of benefits, keeping you in touch with the Trader Talks webcast channel. So go ahead and click on that subscribe button for me right now, and let's jump into this discussion. So I'm going to preface all of this discussion with a response to a request that comes up often, and it's come up recently in our feedback surveys, and that is the where and why of this type of strategy. Why, right? Where and why we would want to consider long verticals in this particular circumstance. And some asks a great question. Why would we want to consider long vertical spreads when the VIX is low and potentially staying low? That's what I'm going to say. Potentially staying low, because we don't know that VIX is going to stay low. Because it doesn't always, because news can happen, right? And that's the scenario. So the thought process behind a long vertical spread is that generally it's a trade that benefits from low and rising implied volatility. Well, low and rising implied volatility benefits long option traders generally, right? assuming that the price of the stock makes a move, and assuming that that option that we choose is Vega sensitive, meaning sensitive to a rise in implied volatility, that certainly works in our favor. But there are, remember, two other factors going on when we select a strategy or when we select a trade, namely directional price movement, number one, and number two, time decay, right? Those are some of the characteristics. So as we look at this process, right, we can't just simply say, we're not going to trade long vertical spreads because implied volatility is low overall. We have to kind of look at it in a little more granular basis. So I appreciate the question, appreciate certainly this being the topic of our discussion. Now, remember, everything else being equal, spread trading needs to be done in a margin account. So as we put these trades together, that might be a where, right? Now, the why might very well be simply looking at the possibility of a move to the upside. And I know, look, or a move to the downside. I know that many traders are option sellers, or like to be option sellers from the perspective of saying, hey, look, I want to bring in the money up front. I don't want to have to wait. I want to see that money in the account right away and then see how much of it I can keep, as opposed to the perspective of saying, look, I'm going to put money into the trade and see how much potential maximum gain I can collect if the stock does what we expect it to do. One of the differences between a long vertical spread and a short vertical spread might very well be the circumstance of what potentially happens at or near expiration in the event of assignment of the short leg. Because if our intent in a long vertical spread is to have the trade be in the money at expiration, then assignment and exercise, which gets us to really kind of the same scenario, becomes a desirable outcome, because that could get us to theoretical maximum gain. So that may be one of the differentiating factors between a long vertical spread and a short vertical spread. Assignment and exercise on a short vertical spread, not such a great thing. Assignment and exercise on a long vertical spread potentially puts the trader in a position of seeing theoretical or close to theoretical maximum gain on the trade. Now, let's take a look at the current market conditions now that we've kind of expressed the why, right? And in terms of comparisons in this scenario, let's take a look at what's going on, right? So we see that the market has rallied up strongly. It's maybe pulled back. I talked a little bit about this 2 days ago in my trading flag patterns webcast, looking at this as the potential for maybe a bull flag, right? A little bit of a bounce, but we're seeing some neutral movement here. We're seeing some neutral movement in the NASDAQ as well, a little bit of a pullback in the RSI in this particular case. So again, potentially some flagging movement and a little bit more downside movement, not so much neutral here in the small caps. I talked a little bit about this morning with Brent in the chat on the futures trading webcast this morning, which if you want to, you can go out and check out on the Trader Talks webcast page. I'll ask Brent if he can find the link to that particular webcast. So as we take a look at this scenario here, we've got kind of some neutral movement kind of across the board. Now, maybe the more important perspective, to go back to Soma's question, which was, well, wait a second, if the VIX is low, why are we looking at long vertical spreads? Specifically, why are we looking at long call verticals, right? So notice what's going on here with the VIX. This is the volatility index of the S&P 500. And it's an expression of kind of the market's expectation of movement, right? There's a lot of different ways that traders look at and evaluate and view the VIX. But one of the things that we've seen happen here is, even though there was kind of moderate trading, or seeing that little bit of a move to the downside of the market or neutral market movement, we're seeing the VIX kind of bleeding off a little bit. It's down now just under the 14 mark, down into the 13 handle. So it's getting a little bit lower, right? And if we look at the correlation between the VIX and the market, this is kind of an odd situation. Let me grab my magic marker, where we have the market kind of trading in a neutral to downward fashion, but we have volatility falling. Oftentimes, if we see the market falling, we see the VIX rising, right? Kind of that inverse correlation. Look at where our correlation still is. Now, remember, this is a 10-day look back on correlation. So this little pullback yet might not be impacting this correlation. What we're likely to see is if this condition persists at this point, where the market is pulling back and VIX is also falling, is we're likely to see that correlation change from where it is right now, which is almost an inverse, which would be a -1 correlation, to seeing that correlation rise a little bit to being kind of a little bit of a differential correlation between those two. And we've seen those circumstances happen where we've seen the VIX falling. Here's another scenario: VIX falling, market falling, where that correlation rose very, very quickly out of that -1, and we started to see that correlation change, right? So this is a circumstance that certainly can happen. It's not the usual, right? This correlation generally stays down in this very near to the -1 correlation, and very rarely flip-flops to a positive correlation where both of those are trending in the directional in that directional approach, right? So that's kind of the scenario here. How did I draw this comparison chart? That's super easy. Great question to ask, Joe, as we kind of look at this in terms of the setup. I simply go to the Flask icon up here. I put on the comparison study, and I put the SPX on there compared to my base, which is the VIX. So VIX is the candle chart, SPX is the line chart, and there is the comparison between the two. All right. Now, one other comparison that I want to look at as we get into this discussion to kind of go back to this volatility scenario is this. I want to look at VIX versus VVIX. Now, VVIX, that symbol, VVIX, is the volatility of VIX. It shows us how volatile VIX is, right? And it's so that's why it's oftentimes referred to as the volatility of volatility. How volatile is volatility? And this is where I want to go back to someone's question, which is the VIX is staying low. Well, wait a second. Is it really? Because we have a rise in volatility of volatility. Volatility may be pushing lower, but whenever we see a divergence between momentum and price, or price and volatility, or we see a divergence in this case between volatility of volatility and volatility itself, it's likely an indicator of potential change. Doesn't guarantee that directional change is going to happen in a particular direction. It doesn't guarantee that our volatility is going to be moving lower or moving higher. But generally, what we see is when there is a divergence, and we can see that scenario happening here, right? There's a divergence between volatility and VVIX, a divergence in that scenario. Volatility was rising, VIX itself was still falling, and then we started to see a little bit of a push to the upside in terms of volatility. Oftentimes, that's what happens, is that this resolves itself in a bullish, it resolves itself in an upward. I got to use the correct terminology here because it's not necessarily bullish. Maybe that the market is pulling back. Resolves itself in an upward move in volatility. When you see that positive divergence, volatility increasing, but volatility falling, this divergence type of direction often resolves itself in an upward direction for volatility. So volatility may be low, no guarantee that it's going to stay low, regardless of political or administration changes or anything else. This is an expectation by the market in terms of volatility. So regardless of what that scenario might be, there is that possibility that VIX rises. And VIX tends also to be a mean reverting instrument. Regardless of what its volatility level is, regardless of what the VVIX is telling us, volatility tends to be a mean reverting instrument. So when it is low relative to its average, it oftentimes rises. When it's high, it very often quickly resolves back to the downside, much more quickly resolving back to the downside than it does when it's low. So I'm not saying that this volatility is going to turn around right now or today, but the fact is volatility is low. It's getting pushed well below its average. That average is turning down, but it's likely to rise based on the fact that it's mean reverting back to its average in this particular case, that average up around the 18 or 19 mark, right? So if we see that volatility is kind of well below that area, likely to see that rise in volatility. So how does that benefit as the trader of a long vertical spread? Well, generally long vertical spreads, again, because the basis of a long vertical spread is the long option, rising implied volatility tends to benefit long vertical spreads, maybe to a smaller degree, but than direction, but still has that potential for benefiting the long side of the vertical spread. Okay, let's take a look at an example here. Let's take a look at a long call vertical example, and I happen to have one, which is DHR, Danaher. And I want to look at it from this particular perspective. What I'm going to do is I'm going to bring up my single grid here, and that single grid is just my playground for looking at this scenario. So Chris asks a great question along the discussion here. So I'm going to bring up DHR while I'm talking about this. So here's Danaher. So Chris asks the question, is 30 days the typical average period for VIX that people consider, or should it be longer? There are longer expressions of volatility, but 30 days, if you think about it, is typically one expiration cycle, or what was typically a monthly expiration cycle. With the addition of weekly options and single day expiration options, there may be even a shortening of volatility, right, in terms of that perspective. So there are other ways to look at volatility besides just a 30-day average. That is the typical approach, is looking at that 30-day time frame. That's what's typically considered to be the VIX. But if you type in VIX right here, you're going to see that you have a 6-month VIX, you have a 1-year VIX, you have a 9-day VIX, you have a 1-day VIX. I'll just show you what this looks like really quickly. I don't want to get too deep down this particular rabbit hole. But if you look at this in terms of the normal VIX, that's 30 days. Let's look at the 1-day VIX. Here's the 1-day VIX, and we can see that that 1-day VIX is slightly higher, but it generally does, right? I mean, this is generally seeing upward movement. So over the course of the day, volatility typically tends to rise unless there is something specific, in this case, like an election or something that causes that 1-day volatility to drop. But overall, it typically tends to track with the longer term, kind of that intermediate term VIX of the VIX itself, right? So there's the VIX versus the 1-day VIX. Great idea, great question to ask, and a good consideration for this discussion. So let's go back to DHR and let's take a look at this particular perspective. Well, not DHL, DHR, we want yogurt, not deliveries. So here's Danaher. And taking a look at this scenario, we've got the price of the stock pushing down towards a level of support. We've got a hammer candle. No guarantee that we're going to get a bounce, but that might be the possibility of a turning point here, or a little bit of a bounce. That 1-day candle giving us that hammer perspective, maybe seeing a little bit of a shift. But what caught my eye in this particular example were two things. One, this move up, or this positive, or what's sometimes referred to as a bullish divergence in the RSI. So momentum starting to pick up a little bit and push potentially prices. That may be an indication that buyers are starting to nibble. That may be one of the reasons why we're seeing this hammer candle here, that potential for a bounce up off of that support and that move up, right? June points it out exactly. It's a bullish divergence. These typically tend to be a little bit stronger in effect on the price of the stock than a bearish divergence, where you see price making a higher high, but you see the RSI making a lower high. That typically will indicate a pause, but a bullish divergence oftentimes will indicate, again, remember, future results are not guaranteed, but this oftentimes may indicate the possibility of a bounce. Now, the other thing that I happen to notice is, and I'll put this in here by adding IMP, implied volatility, into the study set, and we'll click on apply and OK, is that implied volatility is low and rising at the same time that the price of the stock is sitting down on this support level. Given the fact that it was high and falling after the earnings announcement, now we're seeing the opposite scenario. Implied volatility low and rising, which benefits a long option trader, right? Specifically a long call option trader in this case, if the expectation is that the price of the stock may bounce up off of that support level and make a move to the upside. No guarantee of that, however, just given the scenario here, right? So we've got low and rising RSI, we've got low and rising implied volatility. One other way to see this, right? One other way to see this is if we go to the trade tab, and I'm just going to ask the question, how many of you on a regular basis use the information that's presented down here under the option chain in today's option statistics? You don't have to raise your hand. That's just a rhetorical question. If you want to answer, go ahead. But if you're not using this, this is maybe something to include in your process. So what I'm looking at in this particular case is this scenario here, right? Current implied volatility percentile. Current implied volatility percentile is down in the 29th percentile. What that simply says is if 33% is the high, right? 33 is the high that implied volatility has been at over the last year, and 18 is the low. The current level of implied volatility, which is 23.25, kind of puts implied volatility right here at the lower range of that percentile range. So if this is our range of volatility, where is the current level of implied volatility at 23%? It's down in the lower portion of that range. So if this is the 50th percentile, it's low and has the potential to rise because implied volatility is mean reverting. If this were above the 50th or maybe the 60th percentile, we would maybe look at that as being high and the potential for it to fall. So that's something that you could use on a daily basis as you evaluate strategy choices, right? As you evaluate strategy choices. Now, to answer John's question here, which is how to decide between a long call and a long call vertical, right? Let's talk that process through. So let's come back over here and let's take a look at that time frame, right? So if our expectation is that the price of the stock is going to make a move to the upside, it's got to do that directionally, and it's got to do it pretty quickly. So buying the stock itself has a delta sensitivity or a directional sensitivity of 1-to-1, right? The price of the stock goes up $1, the position gains $1 per share, right? If we buy a long call, let's say we were to go out 43 days to go until expiration, and we buy a long call, let's say we were to buy a 230 strike long call, that's got a directional sensitivity of about 73 cents, meaning it's very directional or very directionally sensitive. For every dollar that the stock moves, this should gain about 73 cents. But it's also got a time decay factor of about 9 cents, right? So every day that passes, theoretically, we're losing about 9 cents out of that scenario. We're losing about 9 cents in that scenario of time decay. And then it's got a volatility sensitivity of about 27 cents. So if implied volatility is low and rising, which we see that it is, that could be beneficial to that long call. Now, someone asks a great question. You know, DHR is still below the 10-period exponential and the 30-period simple on both daily and weekly, right? And the idea is that, yes, relative strength is improving. Remember, let's go back to the chart. What do we see happening on RSI? We're seeing a bullish divergence on RSI with a hammer candle. So no guarantee that this is going to bounce, but that's the reason why we're looking at this as being bullish in this particular circumstance, because we're seeing that bullish divergence in relative strength, right? Bullish divergence in relative strength at a level of support. So we're going to take advantage of that in a way that is directionally sensitive, but not as directionally sensitive as buying the stock, not as directionally sensitive as buying the long call, and not as expensive as buying the long call. Because if we were to buy that long call, we're looking at $14.20 basically of premium versus $239 of premium for buying the stock, or $239 of investment in buying the stock. But what we're going to create is a long call vertical that reduces the directional sensitivity, right? It doesn't mean that we're going to see necessarily stronger directional movement, or that we need stronger directional movement. It's going to reduce the impact of time decay, and it's going to reduce the sensitivity of directionality to this trade to less than if we were buying the long call, and it's going to make it a little bit less expensive, right? So if we were to just do this, right? If I were to click on the 230 strike and buy the long call, and we click on confirm and send, we've got infinite maximum gain, theoretically. The likelihood of Danaher going to infinity, probably pretty low, but we can see what our cost of the trade is, or what our input into the trade, $1,420, right, per contract. But if we were to do it this way, right, and in addition to buying that 230 call, we were to sell, say, for instance, a 245 call, right? Let's go back up to the chart and see where that expectation is. 245 or maybe 250, that's kind of right back up here to this level of resistance. 245 is attenuated from that somewhat, so it might be okay looking at that move from where it is here at 240 up to about 245. So we're going to sell the 240 call, or maybe the 245. And now what we've created is a long call vertical spread for a lower net debit, meaning if we click on confirm and send, we have the potential to make 675. That's the price of so that's the width of the spread minus what we're paying for it. Maximum theoretical loss isn't the 1,400 that it was when we were buying the long call. It's now about half of that maximum theoretical loss, the cost of the spread, the maximum theoretical profit. Not infinite, but it is defined now at that short strike, right? Okay. So in this particular case, Jerry, open interest might be the concern. So what I'm going to talk about is maybe finding a scenario where there's maybe a little bit more open interest, or a little bit narrower bid-ask spread. Remember, we went out a little bit further in time. So what I'm going to do here in this particular case is we'll look for that scenario, right? That's a 43 days to go until expiration weekly option. That just started trading fairly recently in the list of spread, or in the list of expirations. So I'm going to go one that maybe has had a little bit more time, the 13th of December. And because I don't need as much directional movement, and these have been trading for a little bit longer, see that bid-ask spread is a little bit wide, or a little bit narrower. So let's create the same trade here, 230. We're going to buy the 230, and we're going to sell the 245. Now our 860 net debit is roughly the same. And I can click on confirm and send. I've got roughly the same balance between my max theoretical gain and my max theoretical loss. So let's talk a little bit about the whys here, guys. Oh, by the way, yeah, there's a feedback survey there. If you can help me out, either click on that link to the feedback survey and set that aside and then come back to it, or fill out that feedback survey before you go. I'm simply asking you to do that. That helps us out to make these sessions better. But here's what we've done. If we take a look at this, we've created a vertical spread that has a net delta in this case, if we take a 75-cent positive delta and we subtract from that a 38-cent negative delta, this is still delta sensitive, right? Greater than the amount of the vega sensitivity or the theta sensitivity. Still has about a 37-cent delta sensitivity. So it's still bullish. It's just not as bullish necessarily as the long call or bullish as buying the stock, right? It's early in the day, John, so I'm not worried about the volume necessarily. I'm more worried about the width of the bid-ask spread here at this particular case, right? Bid-ask spread, probably a better indication than volume necessarily of liquidity, at least especially early in the morning as things get moving. If we're concerned about it, we might look at a different instrument. Okay? Now, given this, we've got 29 days to go until expiration. Notice that what's changed is that our Vega sensitivity has increased a little bit because we're closer to expiration. So we've got a little bit higher theta or time decay to overcome. But at the same time, look at the strikes that we're choosing here, right? We've got a 230 strike that has an 11-cent theta, and we've got a 245 strike that's got an 11-cent theta. Well, wait a second. Now we've got essentially a theta neutral trade, at least at the moment when we put this trade on. So I'm not worried about the fact that I am 29 days to go until expiration, a little bit closer to expiration. That theta is increasing. I've essentially taken theta out of the equation, right? Now, the challenge, on the other hand, is look at the dispersion between our volatility sensitivities, right? Look at the dispersion between our volatility sensitivities, right? 21-cent positive Vega versus a 26-cent negative Vega, meaning we've got about 5 cents of negative Vega left, right? So if implied volatility rises, that's going to work against us, but to a smaller degree. If volatility stays about where it is, not going to be much of an issue, right? If volatility falls, that may work in our favor, at least given the fact that that short strike is there. But think about this. Think about this. If volatility kind of stays about where it is and the price of the stock makes a directional move, which is what we expect it to do, no guarantees, we've got a greater delta sensitivity, even though remember our net delta sensitivity is 37 cents. So if we were to say, look, fine, we gain 37 cents by directional price movement, but we lose 5 cents to Vega, we still have a net positive increase to our premium of about 32 cents. So we're creating a trade that is directionally sensitive as the primary driver and not really worried too much about that change in implied volatility. But if implied volatility starts to move, guess what's going to happen? Guess what's going to happen if implied volatility rises? Well, you know what? That's going to push this long leg deeper in the money. It's going to put push the short leg closer to the at the money, or maybe even into the money position, at which case maybe that Vega sensitivity as we get closer to expiration starts to rise. So that might increase the Vega sensitivity of our long leg. And that being the case, then maybe Vega becomes a bigger issue. But volatility staying where it is, not necessarily such a big deal. So somebody asked the question, Wiley, I think, asked the question about how did I find Danaher? I simply scanned for that option characteristic, current implied volatility. I've got a scan that looks for that, but I've got it as a column in my list here. And Danaher is relatively low in that IV percentile. So I was looking for low and potentially rising implied volatility. In this case, looking for implied volatility to be low, or that implied volatility percentile to be below the 50th percentile. So that possibility of the move to the upside. So let's create this trade and see what happens. Now we're getting a little bit deeper. And by the way, if this is if the discussion that we're having in terms of the option Greeks and the discussion of the sensitivities are challenging, I'm going to show you some resources to help you to kind of reinforce these ideas. Now, Generally, when we think about trading along vertical spreads, the way that we've talked about it is trading those with enough time to go that we decrease the theta sensitivity, because theta increases as we get closer to expiration. But the fact is, we've made theta a push here. So we're going to keep this going in that particular perspective out to that 22 or 29 days to go until expiration. We could move it out to the 20 December if we wanted to, all right? Well, let's create this trade and see what it does as an example. And we're going to click on confirm and send. I'm going to make sure that I send this to my long verticals group so that we can keep track of it. And we're going to go ahead and click on, actually, let's do this. Let's make sure that we've got that opened up. Our debit's gone up a little bit. Guess why? Because the price of the stock's gone up a little bit, started to bounce, giving us that move to the upside. So we're paying a little bit more. But we're going to work that as a limit order here. Click on confirm and send, read through, make sure that we're aware of any alerts that exist here. And we're going to go ahead and click on send and fire that order off. Now, the expectation is that the price of the stock is going to make that move to the upside. 245, our short strike, is kind of right up here around a level of resistance, but not a really strong necessarily level of resistance to the upside. Let's look at another example really quickly. I know that we're getting down in terms of time, but let's take a look at another example here, maybe of going the opposite direction. And again, one that has relatively low and rising implied volatility, and that is J&J, Johnson & Johnson. So let's go back over here to the charts. Let's take a look at J&J. And what do we see happening here? We've got volatility that is low and rising, right, in the short term. Now, it maybe not as potentially low as where Danaher was on a percentile basis. But what do we see happening here? All right, Johnson & Johnson maybe continuing to push to the downside. Now, this has changed a little bit since I started to put these ideas together. We're maybe getting a little bit more of a push to the downside, maybe some buying pressure stepping in, but RSI is still kind of moving to the downside. So we don't really see that bullish divergence necessarily here. So the expectation might be in this particular case that we still see some downside movement in Johnson & Johnson based on this idea. Now, the thing about it is, remember that put options typically tend to be used to protect positions or to speculate on downside moves. So puts typically tend to be a little bit more sensitive to changes in implied volatility. So if this starts to move or continues to move to the downside, that may increase implied volatility faster than what we saw on Danaher with a rise in the price of the stock going, moving volatility. But let's look at this scenario, right? So in this particular case, let's look at putting this trade on. We're going to go to the trade tab for Johnson & Johnson. I'm going to look at selling a little bit closer or creating this vertical spread a little bit closer to the expiration date. Maybe we'll come back down in here to the 15 or the 29, no, 15 days to go until expiration. We'll see how wide our bid-ask spreads are, and they're pretty reasonable in this particular case. I'm not terribly worried about that. What we might want to do here in this particular case is maybe think about being a little bit more aggressive to take advantage of that directional price movement, which means that we're going to be more directionally sensitive generally, lower probability of success, but the trade's going to cost less as well. So what we might here in this particular case do is look at, say, for instance, buying the 149. So the stock's got to make a move in order for this vertical spread to make money, and it's got to do it pretty quickly. That's why I'm saying this is going to be maybe a little bit more aggressive or directionally sensitive. So look at buying the 149 put option, and then selling, say, for instance, the 147. So let's make it 2 points wide in this particular case, selling the 147. So our expectation is that move to the downside. Lots lower net debit. Now, it's a smaller price stock, right? It's a smaller price stock. Making that move to the downside has to happen pretty quickly here. We don't have a lot of time to go until expiration, but at the same time, this is a lower cost entry trade. Clicking on confirm and send, we see that our maximum profit is higher. $2 wide spread minus the cost of the trade gives us the potential theoretical maximum gain of 156. Now, let's look at this really quickly in terms of those net Greeks, right? So we're buying the 149 and we're selling the 147, right? So that is, let's go right here, 0.28 minus 0.17. This is still directionally sensitive, just not very directionally sensitive. So now we're kind of in this situation where time has to this directional move has to happen pretty quickly, because if we look at our net theta sensitivity, 149 to the 147, we've got 1 day of negative time decay, or 1 cent of negative time decay working against us. So whereas our Danaher trade was a push, this becomes a negative theta scenario. We've got to see that happen faster than that decay. We're still left with about 10 cents of positive sensitivity, though, if we think about theta kind of offsetting what we're making on delta sensitivity. Now, the other thing to think about here is our Vega sensitivity is about 2 cents positive. So if implied volatility rises, those put options become less expensive, or excuse me, put options become more expensive, implied volatility goes up. That's going to benefit this trade to the tune of about 2 cents. That's going to overcome the 1 cent of theta sensitivity that's negative or working against us. So the best scenario in this particular case, and the reason why, is we're looking at an aggressive move to the downside happening quickly to overcome that 1 cent of theta decay and a rise in implied volatility, which is likely if the price of the stock goes down, right? So in this particular case, shorter term, but looking for a strong move to the downside, net goal is to have the price of this option be at, or the price of the stock be at or below 147 by expiration or close to expiration. So let's put this particular trade on and see how that plays itself out. We're going to go ahead and click on confirm and send, read through this order, make sure that we're aware of any alerts, and we'll bring this down to long verticals and diagonals and click on send. And now we got into that trade for 45 cents. All right. Wow. Okay. So pretty quick run through in terms of those directional sensitivities. But again, it goes back to what's our expectation, right? What's your opinion about what the stock is going to do? Our expectation in this case might be a downside move, right? Implied volatility low and rising. RSI kind of sitting about where it is, maybe a little bit more downside move in RSI. So looking for a quick move to the downside, it's got to go down to 147, which is only going to be down around here. But the trade's got to make that move, and it's got to do it pretty quickly in this particular circumstance. And so that's why we put the trade together the way that we did. So thinking about kind of in culmination, the whys here, we're looking at a circumstance where implied volatility is low and has the potential to rise. That gave rise to looking for trades that had lower and rising implied volatility percentiles and looking at the directional sensitivity of each one of those scenarios. Guys, thanks very much for joining me. And again, if you want to learn more about option Greeks or about the net Greeks, let's look right here. And on the Trader Talks webcast page, just type in Greeks, and you'll get a list of webcasts that talk about Greek sensitivities. Here's one that you might choose as a way to kind of keep in mind these net Greeks. I taught it about, oh gosh, almost a year ago, so it's probably time to do it again. Net vertical Greeks, how to make that assessment of those net vertical Greeks. So great resource to have. Once again, my thanks to Brent Moores for helping out here in the chat. Thanks to all of you. Make sure you fill out that feedback survey if you haven't done so already. Click on the subscribe button and follow us on X at Ben Watson CS, at Brent Moores CS. We'll see you guys again very soon. Have a great day, everybody. Take care. Bye-bye.